Trading is the act of buying and selling financial instruments. These instruments can be stocks, bonds, currencies, or commodities. It all happens in various financial markets around the world. Psychology is the scientific study of the mind and behavior. It seeks to understand how we think, feel, and act. Trading psychology combines these fields. It examines how a trader's mental state and emotions influence decisions. This mental game is crucial for trading success. Financial markets often appear impersonal, dominated by numbers and algorithms. However, markets are made up of people with emotions and biases. A trader's mindset is crucial. Even the best strategy can fail without the right psychological state. Mental strength and emotional resilience are key to consistent trading success. Enduring success in trading is built upon two fundamental pillars, strategy and psychology. A well-defined strategy provides a clear roadmap for navigating the markets. Equally important is a resilient psychological mindset to manage emotions and maintain discipline. Both pillars are essential for consistent long-term trading success. Achieving mastery over your trading psychology is not a singular event. It is a continuous journey of self-discovery and improvement. The financial markets are dynamic and always changing. Your psychological approach must be flexible and adaptable. This journey requires ongoing self-reflection and a commitment to personal growth. Think of it as a marathon, requiring endurance and perseverance. This essay serves as a guide on your journey to psychological mastery in trading. Our minds are powerful tools, capable of complex analysis and rapid decision-making. However, they are not always rational or objective. Our brains use cognitive biases to process information efficiently. These shortcuts help in everyday life but can lead to errors in trading. In trading, cognitive biases can distort perception and judgment. Understanding these biases is crucial for better trading decisions. They shape our choices without full awareness. Recognizing biases helps in developing effective strategies. This awareness leads to more disciplined and profitable trading. Overconfidence bias is a common psychological pitfall for traders. It leads traders to overestimate their abilities and disregard risk. This can result in frequent trading and large, risky bets. Overconfidence often leads to underdiversification and ignoring stop-loss orders. To combat this, traders should focus on quality trades and maintain a detailed trading journal. Anchoring bias is a significant cognitive distortion in trading. It describes our tendency to rely too heavily on the first piece of information, the anchor. In trading, this could be the purchase price or an analyst's initial target. This anchor can skew judgment, leading to poor decisions. Regularly reevaluating positions based on fresh information is crucial. Confirmation bias is a cognitive tendency where individuals seek out information that confirms their beliefs. In trading, this bias can be treacherous. Traders might ignore negative signals, holding on to losing trades too long. Overcoming this requires seeking diverse opinions and adhering to objective trading plans. The herd mentality, or groupthink, describes the tendency for individuals to follow the actions and beliefs of a larger group, often without independent analysis. In financial markets, this bias can manifest as traders piling into popular stocks or trends simply because everyone else seems to be doing so. The fear of missing out, or FOMO, is a powerful driver of herd behavior. When traders see prices rising rapidly and hear stories of others making quick profits, they may feel compelled to jump on the bandwagon, even if they don't fully understand the investment. This collective buying can inflate asset prices beyond their fundamental value, creating speculative bubbles that are prone to bursting when sentiment eventually shifts. Trading financial instruments stirs a wide array of human emotions. It involves money and the future. Gains evoke excitement and joy, Losses trigger anxiety and stress. Market uncertainty amplifies emotions. Every decision feels emotionally weighted. Understanding emotions is key to trading skillfully. Fear is a powerful emotion that traders grapple with regularly. It can manifest as fear of losing money, missing out, or being wrong. This fear can lead to hesitation, missed opportunities, and irrational actions. Managing fear starts with acknowledging it and having a robust trading plan. Confidence in your strategy and risk management is key to keeping fear at bay. Greed often ensnares traders, leading to excessive risk and financial pain. It arises from an insatiable desire for more profit, abandoning rational judgment. Overconfidence from success can lead to overreach. Unrealistic expectations push traders to take shortcuts. Greed tempts traders to stretch beyond their limits, often disastrously. Manifestations of greed are numerous and hazardous. Overtrading and large positions are common signs. Greed can cause traders to hold winning positions too long. This can result in substantial unrealized gains evaporating. Greed might fuel revenge trading, forcing trades that aren't there. It encourages the violation of sound risk management principles. Ignoring stop-loss orders, hoping a losing trade will turn around. Allocating too much capital to speculative tips is dangerous. This behavior makes accounts vulnerable to severe losses. Greed makes traders susceptible to fraudulent schemes. It clouds judgment, leading to rapid capital depletion. Combating greed requires discipline and realistic expectations. Adhere to a well-defined trading plan with clear targets. Knowing when to take profits is key to discipline. Set realistic financial goals for consistent trading. Regularly review performance to keep greed in check. Cultivate gratitude for consistent gains over chasing jackpots. Hope, in many aspects of life, is positive. However, in trading, hope can be a liability. It prevents traders from cutting losses, leading to substantial damage. Regret over missed opportunities or past losses can create a cycle of poor decisions. Traders must cultivate an objective mindset, acknowledging losses and following a trading plan. Use stop-loss levels and maintain a detailed trading journal to manage emotions. Section 5. Cultivating emotional resilience in trading. Emotions are an unavoidable part of trading. The goal is to cultivate emotional resilience, not to become emotionless. This means making rational decisions despite emotional currents. Start by recognizing your emotional state and understanding triggers. Techniques like mindfulness, scheduled breaks, and physical exercise help. Keep a trading journal to track emotions and improve over time. Mastering emotions is an ongoing process, requiring patience and persistence. Emotional resilience distinguishes successful traders. Strengthen this inner fortitude to achieve long-term financial goals. Section 1. The essence of mental discipline in trading. Mental discipline is about adhering to your trading rules despite emotional turmoil. It separates consistently profitable traders from the rest. Without discipline, even the best strategy fails. Discipline ensures you follow your plan every time. Trading is an internal battle between rational plans and emotional impulses. Mental discipline helps you stick to your plan. It is crucial during market volatility and drawdowns. Discipline allows traders to weather storms and capitalize on opportunities. It is foundational for sustainable long-term trading success. Section 2. Forging discipline through a structured trading plan. A trading plan is your blueprint for disciplined action. It outlines what, why, when, and how you will trade. Key elements include entry and exit rules, position sizing, and market selection. Creating a plan is a discipline-building exercise. It forces critical thinking and formal commitment. Your plan is an objective guide during emotional trading sessions. It reduces impulsive decisions and reinforces disciplined behavior. The plan acts as your external disciplinarian. Stay on course even when your resolve is tested. Section 3. The crucible of execution, adherence to trading rules. The true test of discipline is executing your plan consistently. Common pitfalls include FOMO, fear of loss, greed, and boredom. Recognize these pitfalls to overcome them. Use pre-trade checklists and routines to reinforce discipline. Accountability partners or mentors can help. Disciplined execution leads to consistent results. Undisciplined execution introduces randomness and emotional decision-making. Each act of discipline builds confidence. The choice lies with the trader in every trade. Section 4. Patience and persistence. The twin pillars of trading discipline. Patience involves waiting for high-probability setups and letting profits run. It also means sitting out unfavorable market conditions. Impatience leads to overtrading and suboptimal decisions. Persistence is the commitment to your plan despite adversity. Losses and drawdowns are part of trading. Persistence means continuous learning and improvement. Develop patience and persistence through mindfulness and realistic expectations. Focus on process over outcomes. View losses as learning opportunities to build resilience. Section 5. Sustaining discipline. The role of review, rituals, and reinforcement. Achieving mental discipline in trading is a significant accomplishment, but it is crucial to understand that it is not a final destination. Instead, mental discipline is an ongoing practice, a skill that requires continuous cultivation and maintenance, much like physical fitness. Markets evolve, personal circumstances can change, and the psychological pressures of trading are ever present. Therefore, what worked to maintain discipline yesterday might need adjustment tomorrow. Complacency can be a trader's worst enemy once a degree of discipline has been established. Vigilance and a commitment to lifelong learning and self-improvement are essential to ensure that your mental fortitude remains robust and effective over the long term, preventing the slow erosion of good habits. One of the most powerful tools for sustaining and strengthening mental discipline is the practice of regular trade review and detailed journaling. This involves more than just recording entry and exit prices. A comprehensive journal should capture your reasoning for taking a trade, the specific rules from your plan that were met, and, critically, your emotional state and any thoughts or temptations you experienced during the trade. By regularly reviewing this journal, you can objectively identify any breaches of discipline, understand the patterns or triggers that led to them, and assess their impact on your results. This reflective process allows you to learn from your mistakes, reinforce what you are doing correctly, and make conscious adjustments to your approach or your mindset as needed. Developing and adhering to consistent pre-trade and post-trade rituals can also play a significant role in reinforcing disciplined behavior and preparing your mind for optimal performance. A pre-trade ritual might involve reviewing your trading plan, checking for scheduled economic news, mentally rehearsing your response to various market scenarios, and affirming your commitment to discipline. This helps to shift your mindset from everyday concerns to a focused professional trading state. A post-trade ritual, typically performed at the end of the trading day, could include journaling your trades, assessing your adherence to your plan, and acknowledging both successes and areas for improvement. These rituals create structure, reduce impulsive behavior, and promote a consistent, methodical approach to trading. Finally, it is important to use techniques for self-reinforcement of disciplined actions and to learn constructively from lapses without resorting to excessive self-criticism. When you successfully adhere to your plan, especially in a challenging situation, acknowledge that accomplishment. This positive reinforcement strengthens the neural pathways associated with disciplined behavior. If you do experience a lapse in discipline, avoid harsh self-blame, which can be counterproductive and demoralizing. Instead, view it as a learning opportunity. Analyze what happened, why it happened, and what you can do differently next time. This compassionate yet accountable approach fosters resilience and supports the ongoing journey of maintaining and strengthening your mental discipline, which is the cornerstone of enduring trading success. The principles of trading psychology are not just abstract theories found in textbooks. They come alive in the daily experiences of traders all around the world. The mental and emotional state of a trader directly influences every decision they make, from which asset to trade, to when to enter, and crucially, when to exit. These decisions, accumulating over time, ultimately determine whether a trader achieves their financial goals or faces disappointment and loss. The stories of traders, both those who have found success and those who have struggled, provide powerful illustrations of these psychological forces at work. Understanding these real-world impacts can be incredibly motivating for anyone seeking to improve their own trading mindset. It shows us that mastering the mind is a practical and essential skill in the trading arena. Studying examples of how psychology affects trading outcomes offers invaluable lessons. When we look at instances of failure, we can often see clear patterns of emotional decision-making or the detrimental effects of common cognitive biases. These cautionary tales serve as warnings, highlighting the potential pitfalls that await the undisciplined or emotionally unregulated trader. They allow us to learn from the mistakes of others, potentially avoiding similar errors in our own trading journey. Conversely, success stories demonstrate the profound benefits of a strong psychological game. They show how discipline, emotional control, and a resilient mindset can lead to consistent performance, even in the face of challenging market conditions. These examples provide inspiration and a roadmap for developing positive psychological habits. In the sections that follow, we will explore several illustrative scenarios. While the specific individuals may be composites or hypothetical examples, the psychological challenges and triumphs they represent are very real and common among traders. We will look at how easily a trader can be derailed by emotions like greed and fear if they lack a solid psychological foundation. We will also examine how another trader, perhaps facing similar market conditions, can navigate these challenges successfully through discipline and emotional mastery. These narratives are designed to bring the concepts discussed earlier in this essay into sharper focus, making them more relatable and easier to understand. The aim is to provide practical insights that you can apply to your own trading. By examining these case studies, we can better appreciate the critical interplay between strategy and psychology. A good trading strategy is essential, but it is the trader's psychological state that determines whether that strategy will be executed effectively. These stories will highlight how even a sound plan can fail if the trader succumbs to emotional impulses, and conversely, how a disciplined mindset can maximize the potential of any given strategy. Prepare to see how subtle psychological factors can lead to vastly different outcomes, reinforcing the central theme that mastery of the mind is a cornerstone of trading success. These examples will serve as practical guides to understanding the real-world consequences of our inner mental state. Investor Alex began his trading journey with early successes, leading to overconfidence. He ignored risk management, believing every trade would succeed. When the market turned, his losses escalated rapidly. Alex's story highlights the dangers of overconfidence and emotional trading. Always maintain humility and adhere to strict risk management. Now, let us turn to the journey of trader Sarah, whose path to consistent trading success was quite different from Alex's initial easy wins. Sarah started her trading career with a more modest understanding of her abilities and a deep respect for the market's inherent unpredictability. She experienced some early setbacks and quickly realized that simply having a trading strategy was not enough. She understood that her own emotional responses and mental discipline would be key to her long-term survival and profitability. Therefore, Sarah dedicated significant effort to developing her trading psychology alongside her technical skills. She committed to learning about common biases and emotional pitfalls, determined to build a strong mental framework for her trading. A cornerstone of Sarah's approach was her unwavering commitment to a meticulously crafted trading plan. This plan detailed her specific criteria for entering and exiting trades, her rules for position sizing, and her overall risk management strategy. Before each trading day, she would review her plan, reinforcing her commitment to its rules. Crucially, Sarah maintained a detailed trading journal. In it, she recorded not only her trades but also her thoughts, emotions, and any temptations she felt to deviate from her plan. This practice provided her with invaluable insights into her own psychological patterns, allowing her to identify weaknesses and reinforce her strengths. She understood that consistency in process was paramount to achieving consistency in results over the long haul. There were times when Sarah faced challenging market conditions and unavoidable losing streaks. During these periods, fear and self-doubt naturally began to surface. However, Unlike traders who might abandon their strategy or resort to impulsive actions, Sarah relied on her discipline and her plan. She reminded herself that losses were a normal part of trading and that her strategy had a positive expectancy over the long term. She focused on executing her plan flawlessly, managing her risk on each trade and avoiding the temptation to make back losses quickly. Her emotional resilience allowed her to weather these storms without letting fear dictate her actions. She treated each trading day as a new opportunity to apply her process correctly, independent of recent outcomes. As a result of her disciplined approach and strong emotional control, trader Sarah achieved consistent, albeit not always spectacular, profitability over time. She did not aim for overnight riches but focused on steady growth and capital preservation. Her success was not defined by huge, risky wins, but by her ability to manage losses effectively and to capitalize on opportunities that fit her strict criteria. Sarah's story illustrates how psychological strengths like patience, unwavering discipline, emotional resilience, and a commitment to continuous self-improvement are the true foundations of sustainable trading success. Her journey shows that mastering oneself is just as important, if not more so, than mastering market analysis techniques. Section 4, Two Traders, One Market, a study in contrasting psychologies. Imagine a scenario where unexpected economic news hits the financial markets, causing a sudden surge in volatility. Trader Adam reacts with fear, making impulsive decisions while trader Ben stays calm, following his plan. Adam's emotional trading leads to losses, while Ben's discipline preserves his capital. The study shows that a trader's psychological response is key to success. Section 5 echoes from trading legends, psychological wisdom from the greats. Throughout the history of financial markets, many legendary traders have openly acknowledged the profound importance of psychology in achieving and sustaining success. Their stories and writings often highlight that mastering one's emotions and maintaining mental discipline are just as critical, if not more so, than possessing brilliant analytical skills or a unique trading system. These giants of trading learned, often through painful experience, that the markets are a relentless test of psychological fortitude. Their reflections provide timeless wisdom for any aspiring trader looking to navigate the complexities of the psychological game, offering insights that remain highly relevant in today's fast-paced trading environment. These accounts consistently emphasize that internal control is paramount. One famous example is Jesse Livermore, a speculator from the early 20th century, often regarded as one of the greatest traders of all time. He made and lost several fortunes during his career. Livermore's biography and his own writings reveal a trader of immense skill and intuition, yet one who also struggled profoundly with emotional control. His periods of great success were often followed by devastating losses, frequently attributed to his succumbing to greed, overconfidence after big wins, or impatience. Livermore himself recognized these psychological failings, writing about the dangers of hope in losing positions and the need to cut losses quickly. His dramatic boom and bust cycles serve as a powerful, albeit cautionary testament to how even immense talent can be undermined by an undisciplined mind. In more contemporary times, trading educators and highly successful traders continue to emphasize the psychological dimension. Mark Douglas, in his influential book Trading in the Zone, powerfully argues that the key to consistent results lies in developing a trader's mindset that accepts uncertainty and manages expectations. He stresses the importance of thinking in probabilities and detaching oneself emotionally from the outcome of any single trade. Many successful modern fund managers and proprietary traders also speak about the rigorous psychological training and discipline required in their institutions. They understand that a trader's ability to follow rules, manage risk, and handle stress calmly is a core component of their overall performance and longevity in this demanding profession. The collective wisdom from these trading legends, both past and present, converges on a central theme. While market knowledge and a sound strategy are necessary, they are insufficient on their own for long-term success. The true edge often comes from mastering the inner game understanding and controlling one's own psychological tendencies. The stories of those who conquered their emotional demons to achieve lasting success and the cautionary tales of those who did not provide invaluable lessons. They reinforce the idea that developing mental discipline, emotional resilience, and self-awareness is not just an optional add-on, but an essential, ongoing endeavor for every serious trader aiming to thrive in the challenging world of financial markets. Section 1. Synthesizing the core pillars of trading psychology. True and lasting success in the financial markets hinges significantly on psychological mastery. This mastery stands as an indispensable partner to any sound trading strategy you might develop or adopt. The internal landscape of you, the trader, encompassing your thoughts, your ingrained beliefs, and your immediate emotional responses, profoundly shapes your entire experience and ultimate performance in the markets. Many aspiring traders invest immense effort in refining their technical strategies, but unfortunately neglect the crucial development of their mind. The dynamic interaction between these two pillars, robust strategy and strong psychology, forms the very bedrock of any sustainable and successful trading career. Mental discipline is the essential bridge that connects a sound, well-thought-out trading plan to its consistent and effective execution within the demanding, often chaotic, live market environment. This vital internal strength, this disciplined mindset, is ultimately the final arbiter of long-term, sustainable trading success. Section 2. Charting your path to enhance trading psychology. Focus on actionable steps and practical strategies to enhance your trading psychology. Cultivate self-awareness and practice detailed trading journaling. Journaling should capture thoughts, emotions, and decision-making processes. Develop a comprehensive trading plan and adhere to it. Engage in mindfulness meditation and regular exercise. Take breaks to reset your emotional state. Embrace the journey of personal growth and self-discovery. Celebrate small victories and focus on disciplined execution. The path to better trading is linked to becoming more self-aware and disciplined.